You're watching Mirror 7 News. Stay informed, stay ahead for more news.
The Federal Reserve has just made a major move that affects everyone from homeowners to job seekers. On September 17th, the Fed announced a quarter-point cut to its benchmark interest rate, bringing it down to a range of 4% to 4.25%. This marks the first rate reduction of the year, and is widely seen as the start of a series of cuts aimed at making borrowing cheaper for consumers. Officials have hinted that 2 more reductions could follow before the year ends. Typically, the Fed raises rates or keeps them steady to control inflation, but when it lowers rates, the goal is to stimulate economic growth. This decision came after a series of disappointing jobs reports revealed that the labor market is showing signs of weakness. Job gains have slowed, the unemployment rate ticked up slightly, and inflation, while somewhat elevated, has remained a concern. Interestingly, tariffs were noted as a factor affecting consumer prices, though Fed Chair Jerome Powell described their impact as likely short-lived, a one-time bump rather than a long-term problem. This was also the first Fed meeting to include Stephen Miron, President Trump's recently confirmed pick for the Board of Governors, who actually dissented in favor of a larger, half-percentage point cut. Governor Lisa Cook, despite her ongoing legal battle with the administration, also participated, highlighting the Fed's effort to continue its work independently of political pressures. Powell emphasized that the central bank's decisions are guided strictly by incoming data, not political influence. So what does this rate cut mean for everyday Americans? For one, lower interest rates can make loans and credit cheaper over time, but Powell cautioned that mortgage rates aren't likely to drop significantly without more substantial Fed moves. The housing market faces a deeper, structural shortage that rate cuts alone cannot solve. However, the move is expected to help the broader economy, including a low-firing, low-hiring job market that has been challenging for young workers and recent graduates. Markets reacted as anticipated. The Dow ended the day higher, while the Nasdaq and S&P 500 fell slightly, reflecting mixed investor sentiment. The Fed's dot plot projections show that rates are expected to remain below 4% in the coming years, signaling continued support for growth. Inflation is projected to stay above the Fed's 2% target until at least 2028, so policymakers are balancing the twin goals of price stability and maximum employment carefully. In short, the Fed's move signals that economic conditions are being closely monitored, and that steps are being taken to encourage borrowing and spending. While it won't instantly solve issues like the housing shortage or labor market weakness, it's a sign that monetary policy is being adjusted to keep the economy on steady footing. Stay subscribed for more videos.